It is Monday, January 26, 2026. And if you've been anywhere near a financial news feed lately, you know the air is getting, a little thin. We are sitting exactly 1 week away from what's shaping up to be a defining moment for the market this year.
It really feels less like an earnings report and more like a referendum, doesn't it?
It really does. We're talking, of course, about Palantir Technologies, ticker symbol PLTR. We have a stack of research here, analyst notes, historical data, recent press releases. And the mission for this deep dive is pretty specific. We need to figure out why this one company has created this, reality distortion field.
Right, where half the market thinks it's the second coming of the internet.
And the other half thinks it's a radioactive bubble.
And that is not an exaggeration. We are 7 days out from the Q4 financial report on February 2nd. The tension is so specific because you have two completely different realities just colliding. One reality says this is the perfect synthesis of SaaS and, artificial intelligence.
In the other reality.
The other says this is a valuation hallucination that is about to correct. Hard.
Wall Street's most hated stock. That's the phrase that keeps popping up in the sources. I want to start there because it really sets the stage for everything else. Usually when a company hits a certain size, and Palantir is huge now, you see the establishment sort of, grudgingly accept it. But that hasn't happened here.
No, the resistance has actually entrenched itself. Yeah. And we have the numbers to prove it. We looked at the breakdown of the 26 major Wall Street analysts currently covering the stock as of this morning.
And what's the verdict?
It's stark. Only 23% rate the stock a buy or strong buy.
Only 23%.
Yep. That leaves a massive 77% of the institutional coverage universe taking a hard pass. They're holding, selling, or just frankly skeptical.
77% is a massive number. I mean, to be the contrarian here, surely they aren't all wrong. These are people who build models for a living. What are they seeing that the retail crowd, the so-called Palantirians, are just glossing over? Is it purely the price tag?
The price tag is the headline, yes. But it goes deeper into how they value software.
Yeah.
Traditional analysts, they're trained to look for mean reversion. They look at price to earnings, price to sales, and they compare those multiples to a peer group, like a Salesforce or Microsoft or Datadog.
And Palantir just breaks the curve.
It shatters the curve. As of right now, the market cap is sitting at $399 billion. The share price is hovering around $167.53. When a traditional analyst puts that into a spreadsheet next to historical norms for a software company, the spreadsheet, it effectively screams error.
Huh. So they see a valuation that implies perfection for the next decade.
Exactly. And in their experience, perfection rarely happens.
So the bear case isn't just, we hate this company. It's mathematically, this is priced as if nothing will ever go wrong again.
Precisely. They are betting on gravity. They believe that eventually the hype cycle around AI will cool, enterprise spending will normalize, and Palantir's multiple will compress down to something reasonable. And if that happens, you're looking at a massive drawdown. That's the fear.
Okay, so that's the wall of skepticism. But here's where it gets really interesting, and frankly, where all the drama comes from. Because while the analysts are waiting for gravity to kick in, the company, well, it seems to be operating under a different set of physics.
This is where we have to talk about momentum, and not just stock price momentum. We're talking about fundamental business velocity. The source material references Newton's first law, but we don't need a physics lesson to understand the concept. A business that is accelerating tends to keep accelerating unless it hits a brick wall. And right now,
there's no wall in sight.
Not at all.
So let's look at the motion part of that analogy. Because growth is a vague term. You can hack growth by buying companies or dropping prices. Is that what's happening here?
No, not at all. This is organic velocity. If we look back to the IPO in 2019 and draw a line to where we sit today in early 2026, revenue has grown more than 700%.
Which is impressive, sure. But lots of SaaS companies grow the top line. The criticism has always been that Palantir burns cash to get that growth, buying revenue effectively.
That might have been true 5 years ago, but that narrative is dead. And this is the stat that I think the bears are ignoring at their peril. In that same period where revenue grew 700%, net income growth hit a staggering 1,320%.
Wait, run that by me again. 1,320%.
Yes. They aren't just getting bigger, they are getting exponentially more profitable as they scale. This is the operating leverage holy grail. It means that for every new dollar they bring in, they're spending less and less to earn it. They've transitioned from a cash-burning startup to a cash-generating machine, and that transition happened much faster than the street expected.
That does change the calculus. If you're profitable, you control your own destiny. You aren't at the mercy of interest rates or capital markets.
Exactly. It creates a self-reinforcing loop. You have runaway sales, which funds massive R&D, which creates a better product, which leads to more sales. It's a flywheel. And the source material argues that this momentum is just. It's incredibly difficult to stop without some kind of massive external shock.
But momentum doesn't just appear out of the ether. You need a catalyst. Something changed. Because for a while there, Palantir was sort of range-bound. They were the government contractor company. Then suddenly, they became the AI darling. The sources point to mid-2023 as the inflection point.
Mid-2023 is the line in the sand. That's when the sequential revenue growth started to accelerate every single quarter. And the driver is unambiguous. The release of AIP, the artificial intelligence platform.
Okay, we need to stop here and really dig in. Because AI platform is a buzzword salad. Every startup with a PDF wrapper is calling itself an AI company right now. It is noisy. Why is AIP different? What is it actually doing that justifies a nearly $400 billion market cap?
This is the critical differentiator. Most companies, they treat AI as a chatbot overlay. You ask a question, it gives you an answer based on training data. That's cute, but it's not an enterprise operation. Palantir approaches it differently. They use something called an ontology.
Ontology? That sounds philosophical.
It is, in a way. It means mapping the physical reality of the business into a digital twin. So AIP doesn't just know about your data. It understands the objects of your business. It knows what a factory is, what a truck is, what a customer order is, and, crucially, how they all relate to each other.
So instead of just searching a database, it understands the actual logic of the business.
Exactly. And because it understands the logic, the ontology, it can act as a wrangler for the AI models. This is that AI wrangler concept mentioned in our research. Large language models by themselves are prone to hallucination. They're creative, not accurate. You can't run a supply chain on creativity.
Right. You don't want the AI to write a poem about shipping. You want it to route the container to the right port.
Correct. AIP acts as the control layer. It allows the enterprise to use the intelligence of the LLM but constrains it within the logic of the ontology. It integrates with the ERP systems, finance, shipping, manufacturing, and lets the AI pull real levers.
Okay, so let's make this concrete. Say I'm a manufacturing CEO. How does this actually look in my day-to-day?
All right, scenario. A hurricane is hitting the coast and disrupting a key supplier. In the old world, the silo world, your supply chain team sees the delay. They email the finance team to ask about budget for expedited shipping. The finance team checks Excel by the time they reply.
The manufacturing line has already stopped. The classic death spiral of email.
Right. With AIP, the system sees the weather alert, cross-references it with the supplier and the ontology, calculates the impact on the manufacturing line, checks a real-time budget, and presents the user with 3 options. Reroute for $50 K cost, delay production by 2 days, or source from alternate supplier. You click one button, and AIP executes the orders across all those systems.
It effectively automates the entire decision-making loop.
That is the magic. It turns AI from a toy into an operating system, and that is why the adoption has been so fierce.
And fierce is the word used to describe their go-to-market strategy too, the boot camps.
Yes. We can't overlook this. They stopped doing traditional 12-month sales cycles. Instead, they say, give us your data for 5 days, we will build a use case. Customers see the value in under a week. That is why the velocity is increasing. They collapse the time to value.
Which brings us to the immediate future. We have the momentum, we have the tech, and we have the sales strategy. Now we have the scorecard. February 2nd, the Q4 report.
The stakes are astronomical. When you're priced at nearly $400 billion, you are priced for perfection. You cannot just meet expectations. You have to crush them.
So what are we looking for? What's the par score here?
Management has guided for roughly $1.33 billion in revenue for the quarter. That represents a year-over-year growth of 61%.
Let's just pause on that for a second. 61% growth for a company of this size.
It's a total outlier. The law of large numbers usually says growth slows down as you get bigger. Palantir is accelerating. But the number underneath that headline, that's the one I'm watching, the U.S. commercial revenue.
The private sector, the non-SPY business.
Correct. The full-year outlook for U.S. commercial revenue is projected at 104% growth.
Doubling. They're projecting they'll double the commercial business in a single year.
That is the projection. And that is the statistic that validates the entire AIP thesis. You don't get 104% growth in a competitive market just by having a good sales team. You get it by having a product that solves a problem nobody else can touch. That growth rate tells us that the boot camps are converting at a massive clip.
Let me play the skeptic again. 104% growth is incredible, but isn't it already priced in? If they come out and say, we grew 104%, does the stock actually move? Or does Wall Street just say, yeah, we knew that, show us 120%?
That is the danger. The expectations are so high that a great quarter could still result in a sell-off. But there's another metric that provides a kind of safety net: gross margin.
The efficiency score.
The source highlights a gross margin of 80.81%.
80% margins, that's elite software territory. That's Adobe levels.
It is. It means the cost of revenue is incredibly low. Once the software is installed, it is pure profit fuel. This high margin gives them enormous flexibility. If they need to spend more on marketing, they can. If they want to drop more to the bottom line, they can. It proves that this isn't a consulting business disguised as a tech company, which was the old bear argument.
Yeah.
It's a pure software powerhouse.
So we have 61% total growth, 104% commercial growth, and 80% margins. And yet, 77% of analysts say hard pass.
It creates a real cognitive dissonance, doesn't it?
It really does. And the source material alludes to a surprise factor, the idea that management might be, sandbagging.
Palantir has developed a habit of beat and raise. They set a target they know they can hit, and then they blow past it. The author of our source material suggests that given the momentum of AIP and the viral nature of the boot camps, that $1.33 billion guidance might actually be conservative.
If they blow past $1.33 billion, say they hit 1.4 or even higher, what happens to the bear case?
It gets much, much harder to sustain mathematically. See, the bear case relies on the idea that the growth is temporary, a sugar rush from AI hype. But if they deliver a massive beat on top of accelerating guidance, it suggests this is a structural shift in the market. It forces the analysts to reevaluate their models. You can argue a stock is overvalued at 20% growth. It's very hard to argue it's overvalued when it's growing at 60% or 100% in key sectors and printing cash.
It feels like a battle between old school metrics and new school reality. The analysts are using a ruler from 2010 to measure a company from 2026.
That's a very astute observation. Valuation models are built on comparisons. Company X trades at 10x sales, so company Y should too. But what if there is no comparison? What if Palantir is a category of one? If they're the only company that can actually integrate AI into the physical operations of an enterprise at this scale, then the traditional metrics simply fail to capture the value.
They're trying to measure the speed of a rocket with a speedometer from a Toyota Camry.
Laughs. And the Camry drivers are very skeptical of the rocket because it doesn't have four wheels. But we have to be fair to the skeptics on one point. The risk of compression is real. If Palantir reports a slowdown, even a small one, if that U.S. commercial growth comes in at 80% instead of 104%, the stock could get crushed.
Because the premium just evaporates.
Exactly. The premium is paid for certainty of growth. If that certainty wavers, the price corrects. That's the tightrope they're walking on February 2nd.
So let's bring this all together for you listening. We have a market that is totally polarized. On one side, the establishment, 77% of analysts sitting out looking at the nearly $400 billion cap and saying, bubble.
Yeah.
On the other side, the believers, pointing at the undeniable velocity, the 3,320% profit growth, and a tool AIP that seems to be fundamentally rewiring how American business works.
It's the ultimate showdown between price and value. The price is objectively high, historically high.
Yeah.
But if the value proposition is we are the operating system for the entire AI economy, then maybe, just maybe, it's still cheap.
And we will find out who's right very, very soon. February 2nd is the date.
It's going to be a lesson in market psychology regardless of the outcome.
So what does this all mean for you listening right now? Whether you're an investor, a tech enthusiast, or just someone trying to understand where the economy is going, Palantir is the canary in the coal mine for the AI revolution.
I agree completely. It's a test case. If Palantir succeeds, it validates the idea that AI is not just a consumer toy, but an industrial revolution. It means that productivity boom economists have been predicting is actually here. If they stumble, it might suggest that the monetization of AI is much harder and slower than the market is pricing in.
But looking at that 104% growth stat, looking at the way they're converting customers in days instead of months, I wouldn't bet against the revolution just yet.
The motion is certainly heading in one direction.
Here's a final thought I want to leave you with, something to chew on while we wait for that earnings report. We talked about the disconnect. The smart money hates this stock. The dumb money retail loves it. But historically, smart money is slow to recognize paradigm shifts. They missed Amazon. They missed Tesla for a very long time.
They're often constrained by their own models.
Exactly. So ask yourself this. If 77% of the experts are saying no, yet the company's fundamental motion is accelerating faster than any software company of its size in history, what does that tell us about the tools we use to measure value? Are we looking at a bubble? Or are we looking at a new standard of physics for business growth where the old formulas just don't apply anymore?
It questions the very nature of how we define expensive.
Maybe the bubble isn't the stock price. Maybe the bubble is the old way of thinking.
A provocative thought indeed.
Thanks for diving deep with us today. We'll be watching that February 2nd report closely.
Absolutely.
See you next time.